Thank you very much, Raleigh. Thank you. Appreciate it at Trading Pub, to Yana, to Raleigh, and also thank you to everyone here in attendance today. This promises to be a great presentation because I'm not only going to show you how I like to trade with Bollinger Bands, but I'm going to give you all of the rules, actually, to one of our best continuation strategies for trading the Bollinger Band. So you'll know exactly where to enter, you'll know where to place your stop, and where to use our exit points in its most basic form by the end of today's presentation. Now, Raleigh pretty much explained my career and how I started out on the floor, and then how I branched out and ultimately left. And first and foremost, for you who are unaware or not familiar with specialist trading, we are really an educational website. That's why we fit in so well with what we try to do here at Trading Pub as well, because we're really about educating people so that you can make your own decisions and put the power back in your hands, because it's our belief that most traders fail because you're relying on an outside source, either someone or something, to tell you what to do. Think of your trading right now. Do you go to a chat room or a trading room and just do whatever they're saying in there, or do you wait for a specific news announcement to come out before you can make any decisions, or do you listen to some TV commentator to tell you what to do? Most traders trade that way. In fact, I started trading that way myself, and this is why we believe most traders fail, is because you aren't relying on sound education. And most traders don't have sound fundamental education, so that's what I do. I provide all of my students and members with the education that I've accumulated in 37, just about 38 years now, going on 38 years. So I'm more of a teacher rather than just someone dishing out signals for you to take and to follow. So with that said, now I'm going to share with you this great technique that you can apply in many different ways you'll have in your most basic form. But before we begin, we're required to show you this, our disclaimer, so please take a moment to view it. I'm going to show you a lot of performance results and share with you exactly how to implement this strategy. But please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. So please take a moment to view the disclaimer. And as you're doing that, I would also like to invite each and every one of you, if you're not following us already, to follow us on Twitter. There's our handle right there. It's abbreviation for Specialist Trading. You may want to write that down. That's at SPCLSTTRADG. What I do is I post a lot of great free information on a daily basis. Not only information on stocks, but information on the futures markets as well as the forex currency pairs. I post anything from daily financial wisdom to actual signals that we may be currently in. In fact, just yesterday we posted a buy signal in the market for E-mini traders that generated a gain of close to 10 points in just one day. So it's a lot of great free information that you can take from us. And if you're interested in getting a little bit more in-depth information than you can get just from Twitter, my sister site, I've teamed up with Pro Trader Strategies. They handle all of our marketing and all of our courses and sales. They have a Facebook page where you can like us on Facebook and come visit us there. And there's a lot more information as well, a lot of videos, a lot of more in-depth information on how to get more information about what we do at Specialist Trading. So feel free to like us there and follow us on Facebook. Okay. With that said, here's what you're going to learn today, because as I stated, we are an educational company. We're more about teaching you and educating you, you exactly what we think it's going to make you successful, as opposed to, telling you what to trade, what to buy, where to sell it. We give you the information, but then we let you run with it. So since this is a class, here's what you're going to learn. I'm going to share with you the common Bollinger Band uses. This is the way the Bollinger Bands are used in their most conventional form. And there's nothing wrong with it. It's a great tool. It's a great indicator. We feel very strongly about the Bollinger Bands, but we're going to just share with you its most basic form. And then we're going to share with you how we use it with our proprietary settings. I'm going to actually reveal what usually only the members of Specialist Trading see, and that's the proprietary settings for this particular strategy. And then we'll go into depth and show you all the rules in their most basic format for strategy 3A. This is a great continuation strategy using the proprietary settings we have with the Bollinger Bands. Now, just one thing before we begin, because this is a class and because I'm going to be sharing with you a lot of slides, I realize that many of you may want to have questions. If you kindly just wait till the end of the class, okay, to ask any questions, because I would rather not stop to answer each and every one of the ones you're asking, because then kind of slow down and bog down the presentation. So I really appreciate it. If you just wait, will be done in just about 20 or 30 minutes from now, and then we can spend the remainder of the time for any questions, okay? All right, so let's review. Some of you, I'm sure the majority of you, are fully aware of what Bollinger Bands are, but let's review and see exactly what Bollinger Bands are and their most common use. Here's the standard definition. Bollinger Bands consist of a center line, which is a moving average, and two price channels. These are the upper, the trading bands, the upper and the lower bands of the Bollinger Bands. Now, when the markets become more volatile, when there's a lot of movement, the bands widen or they move further away from the middle average. And during less volatile periods, where we're kind of in a rangy market or there's not a lot of action going on in the markets, the bands contract, or in other words, they move closer to the average. In other words, you'll see the top band coming down lower, and you'll see the bottom band coming up higher, so you'll have this contraction. Now, the tightening of these bands is often used by technical traders as an early indication that volatility is about to increase sharply. So that's its most standard use. When we're looking at Bollinger Bands, this is what we're really looking at in its most standard form, this kind of contraction. And here's the settings that you use. Here's the default settings for Bollinger Bands. Remember, the three bands, the middle one is just simply a moving average. It's a 20-period simple moving average. But the upper band and the lower band have deviations, meaning that this is how far apart they are from that middle moving average. So don't ask me to go into a big explanation technically of what it is, because I really don't even follow it that much. But they're just basically, on all charting software packages, the default setting is usually at +2 for the upper band and -2. This is just referring to the distance they are from the, or the deviation they are from the middle band, which is a 20-period moving average. And if we look at some standard generic charts here, this is the way they look. As you can see here, I'll get out my pointer. When the bands contract, in other words, you'll see the top band heading lower, and then you'll see the bottom band heading higher. You have this kind of contraction here, and it's usually followed by some type of nice movement or volatility. In this case, it was to the upside. Whereas you see in this scenario here, we're moving lower, and this top band is coming down while this one is going up. You have a contraction, and then the volatility increases to the downside. So that's the way they are conventionally used. This is the standard definition and use of Bollinger Bands. All right? Now this brings us to strategy 3A. Why are we going to change or alter things? Because at specialist trading, the way I like to teach and the way specifically I was taught is that things should be more cut and dry. All right? We should know exactly what we are going to be doing when we look at a chart and a particular setup. We don't want to, in other words, look at Bollinger Bands and someone says, well, there's a contraction, and somebody in the trading room says that it's going to go up, and someone else can say, well, no, the guy I saw on TV says it's going to go down. See, there's too much subjectivity there. We want things more cut and dry, where everyone looks at the same chart and comes up with the same scenario. So this is where strategy 3A comes in. It's a great continuation strategy that applies the Bollinger Bands, but in a unique, different setting. Okay, so here's some of the highlights of this particular strategy. It's a continuation strategy. What does that mean? Well, it means that we're going to find the trend. Usually it's a very strong trend, a powerful trend. We're going to wait for some type of pause, and then once the trend continues, we're jumping on board. That's the continuation. All right, so we're going to catch the trend as it pauses, and then it jumps on. So it's not a pullback. We're not waiting to get prices at a lower, more inexpensive level. We're waiting for price to just pause in a nice established trend and then take off into a very strong trend. Now, it uses our unique Bollinger Band setting, which once again is usually just reserved for the members of specialist trading, but I'm going to share it with you today. It's designed to trade quick, powerful trends. Now, you're going to see this in all markets, so don't worry and say, well, you know, does that mean it only for futures or only for currency pairs? No, it actually will show you examples in stocks, we'll show you currency pairs, we'll show you commodities, we'll show you, ETFs. It works in just about everything, all right? And then the more signals you want, well, then you have to go to smaller time frame, just like anything else. So if you like to trade a lot, you're going to see a lot of signals intraday trading. And we mean, even tick charts or 1-minute charts, and I'll show you some examples as well, okay? Please remember, though, that some of the results here, because it is a very consistent strategy. But please remember that even though you're going to get all the rules, do not start trading with this tomorrow. I want you to paper trade. In other words, you can start applying it tomorrow to the markets, and you'll probably do very well with it, but please paper trade, because there's so much more you're going to learn through the process of paper trading. Most students jump the gun far too soon. They think they know everything, and they jump into the market, and they just immediately begin to lose. It's because you really don't understand the process yet. You're probably entering at a faulty entry point, or you're placing your exit at the wrong place because you haven't studied the material yet. This is an extremely simple strategy to apply, but even so, if you really haven't studied it through paper trading, you'll probably implement it incorrectly and then suffer a series of losses. So paper trade it so that you really fully understand the process. Our edge at specialist trading is consistency. This is what we build everything around. We're not the type of company where we promote tons of thousands of dollars made each and every day and humongous results. We don't care about those things. We're not a systematic company. We don't backtest or research anything. We just use the things that I personally use in my own trading and that I've acquired in almost 38 years of trading myself that have stood the test of time. And we realize that everyone trades them differently. There's different ways in which to trade. Some people trade aggressively, some people trade conservatively. Either way, there is a consistency to this method and to all of our methods. So from time to time, you will have some small losses, but that's okay because you usually bounce right back and recoup those losses and then earn even more. So, be patient with this. Learn it like the back of your hand through paper trading and then strive for that consistency. Okay? All right, so let's begin. And remember, I believe Raleigh said this is going to be recorded. So if I rush through the rules, don't worry. You'll probably get a recording of this and you can watch it as many times as you like. But it's extremely, it's a little wordy. So don't feel as if you have to hurry up and write everything down. I'm going to show you a lot of slides where it will probably make more sense through the slides, okay? All right, so here are the indicators we are going to be using. Just two indicators for this particular strategy. A 50-period simple moving average, all right? So it doesn't matter if we're looking at a daily chart, a 5-minute chart, or a monthly chart. You're always going to have a 50-period moving average plotted. And then we're going to have the Bollinger Bands. But here's the setting, as you see here on the bottom. Now, the main Bollinger Band or the middle Bollinger Band will stay where it usually is, at the default setting of 20 period. In other words, it's set at a 20-period simple moving average. But we're just going to change the upper band and the lower band settings. All right? So this is what you may want to write down. Now, the upper band setting is usually defaulted at +2. The lower band is usually defaulted at -2. We're just going to lower them, tighten them up a little bit, and make the upper band deviation at 0.382. See that right there? The lower band will be at -0.382. And that's it. Okay? It's not a big change, but that's really all we're going to be doing. Now, if you're having trouble editing, I know a lot of you are probably going to your chart software right now and trying to edit it. If it should be simple, but if you're having trouble, call your tech support. They should be able to edit it for you if you don't know how to do it, okay? Top band should be 0.382, negative band, -382. Now, there's nothing magical or mystical about this number. This is just the way it was taught to me some 30 years ago on the floor. It works very well, and here's the reason why we use this, okay? Here are the standard settings. We're looking at a standard chart here of Facebook, a very current chart of Facebook. That's the standard Bollinger Band use, okay, as we see here. Now, once we change it to the settings, here's what it looks like. Do you see how we have it really smoothed out now? And it gives you a completely different view of how to implement it. It's totally different because we're going to be using it in a different way as the standard conventional wisdom applies a Bollinger Band. So once you figure it out, it should look something like this, okay? We're just trying to smooth it. And also, remember, that number 0.382 and -0.382 is not written in stone. Sure, a lot of students say, Steve, I've experimented with it, and 0.444 works better. That's fine. Remember, we teach and trade strategies. We don't teach and trade systems. Nothing is back-tested or refined. We don't come up with systematic numbers because everyone trades it differently. So there's no way we could backtest and research 1,001 different users' ways of using it. Our strategies are traded in over 80 countries around the world, in every state in the U.S. So we can't backtest the way everyone trades it to their particular liking. So that's the way it should look, basically like this, once you have it all set up, okay? All right, so let's go through the steps. Once again, this may seem a little wordy, and don't worry if you don't get it. As Raleigh said, this is being recorded, so you should be able to watch this as often as you like. But step number 1, the entry price must be above the 50-period simple moving average. And now when we say entry price, we mean that exactly when you enter your entry must be above that 50 period, all right? Now, this means that, we're not that concerned with where the bars are going to be. You could have a setup bar that's actually below the 50 period. But as long as your entry is above, it's still a valid setup. Now, it's more ideal to see all the bars either on or above the 50 period moving average, but it's still all right. If you have a valid entry, once you learn how to apply this strategy, and your entry is even just one tick above the 50 period, it's a valid setup. All right, so if we look at just an older chart here of the E-mini, this is just a 5-minute time frame. We see here's the 50 period moving average. And here are the Bollinger Bands. See how they're much more smoother and they look much more refined than the other application. And so we want to be above the 50. All right. All right. So let's go to the next step, step number 2. Now we want to look to buy when 5 consecutive price bars. They have to be consecutive and they have to close either on or above that highest Bollinger Band. So you want to see 5 bars close either on or above the highest Bollinger Band, and then create a pivot high. This short-term high will be labeled the setup. Now, if you're not familiar with what a pivot high is, it's something like this, all right? Now, this is an ideal scenario where you have roughly 5 bars, but you could just have 3. All you're looking for is a top followed by a higher top followed by a lower top, and you kind of create this type of arrowhead approach right here. So this is what we're looking for. This is a short-term pivot high. Obviously, a short-term pivot low will just be the opposite. You'll just turn it upside down, and it'll look something like a V. Okay? So we want to have 5 consecutive bars close on or above that high Bollinger Band, and we want to then look for a short-term pivot high once we've had those 5 bars. So if we look here, we see that we have 1, 2, 3, 4, 5 bars close, and coincidentally, within those 5 closes above, we have that short-term top right there. See that? Now, a lot of students say, well, Steve, does the short-term top have to be within those first 5 bars? No. It's just you can either have one or the other. You can have them both together, or you can have first 5 bars closing above, and then you can start looking for that short-term top. All right, but here's the short-term top. So now we have a setup. We have a valid setup. Are we in the market yet? No. We just have a setup. In other words, the environment is perfect for us to go long. This brings us to step number 3. We're going to enter to buy when price trades 1 tick above that short-term high that we just identified. But here's the one caveat. Here's the one thing that we have to realize. We need that to trade very soon. In other words, if the price bar closes below that high Bollinger Band before we enter, we're going to negate the trade, because most likely it's telling us that we've lost momentum, that the momentum is done. Remember, this is a continuation trade. We're trying to catch a quick momentum move. And if price doesn't trade above that short-term high but comes all the way back down and closes below that high Bollinger Band, well, most likely the momentum has left the trend, so we're not really going to apply this. So we just negate this setup and we look for another one. So if we look at the chart again, we see here that we have the short-term setup. As you notice, this is on a 5-minute bar. It works on virtually any time frame, any direction. And if we see, that's where our entry was, because on the very next bar, in this case, we traded above. You see, had we not traded here and gone down and closed somewhere down here, we would negate it, because most likely momentum has dissipated and it may come down lower. Okay? All right, so we entered once we traded, and here's another important question. We do not need to close above there. Okay? This is just an intraday trade above there. So in other words, all we have to do is trade above their intra bar. That's all we need to do. We do not have to in any way close above there. A lot of students say, well, Steve, it didn't close there. I didn't get long. We don't care if it closes there. All we have to do is wait for it to trade 1 or 2 ticks above, and then that's it. Okay? So once we've entered, where do we protect ourselves? If we have to place a stop, well, step number 4, place your protective stop below the lowest short-term low that was prior to entry. In other words, the last low you had, the last short-term low. Remember, we defined a short-term high that looked kind of like a arrowhead. Well, a short-term low just kind of looks like a V. You have a low, followed by a lower low, followed by a higher low. So if we go to the chart, here's where the last short-term low was. See, we entered here, and then we go backwards. Where was the last low? Right here. We had a low, followed by a lower low, followed by a higher low. Kind of creates this little bottom right here. All right? Okay, so we're protected. We've entered into the trade. We have a position now on a 5-minute basis. Where do we get out? Because after all, that's what we're all worried about, right? We want to have a profit. So here's where people usually get confused, but it's extremely simple. It's called a range extension. Some of you may be familiar with it, some of you may not, but we're simply going to sell or exit on a range extension of 200 and or 300%. Now don't get worried. I'm sure you're all saying, what's a range extension? What's that? I don't follow. Very simple. We're going to look at the very top of that short-term top. Remember where we defined it prior to entry? It was right here where that little arrowhead was. That's the top of the range. The bottom of the range is where the rally started. Now, coincidentally, it coincides with our stop placement. Excuse me. So in other words, we were going sideways, and then all of a sudden, bam, the rally started. So here's the range. From the top of that short-term top to where the rally started is 100%. Okay? So whatever that is, it could be 5 points, 10 points, 20 points, 2 points. It doesn't matter. But whatever that range is, you simply measure it, and then you add it on top. Okay? Once you've added it on top, that is your exit at the 200% range. All right? So you can exit right there if you'd like. Now, if you want to go for even more gains, you take the same amount. This was 100% range. You take the same amount, that's 200, and then you add another, the same amount, which is 300. Okay? And that gives you 11 points. So, do you see, this is how simple it is. We're trying to catch that trend. If you look back in hindsight on this 5-minute chart, you see that we had a really nice move. Someone looking back in hindsight would say, boy, it just took off. How would I have gotten in? Well, all we're doing is waiting for this first kind of little pause here. We wait for a little short-term top to be made. We're above the Bollinger Bands. We're above the 50. And then that's our entry point, and we simply measure the range extensions. We can get out here. We can get out here. What a lot of students like to do is say, well, I'll sell part of my position here, and I'll sell another part right here. Even more students go, well, you know what? If I sell right here, it's 1-to-1 risk-reward ratio. So what I'll do is once we get up to 200, I'll move my stop to break even. And then once we get up to 300, that's where I'll exit. So now I've made 2-to-1. Okay? Lots of different ways to trade it. And now we even say that as a suggestion, this is not a rule, but you can even go up to 400%. But that's only if you really have a strong feeling about that there's really going to be a strong range or strong trend. But please, it has in no way would we suggest staying in a trend longer than 400, because then it can really move and against you, and then you'll give back a lot of your profit. So we would suggest in the beginning exiting at 200. As you get to know the strategy a little bit more, exit at 300, or different patterns, half at 200, half at 300, or extend it all to 300. Once you get a little bit under your belt, exit at 400 if you'd like. But that's for advanced traders who really have a strong feel of what they think the market's going to do. This is why I said nothing is back-tested or researched, because there's 1,000,001 ways to trade it. And then we haven't even gone into how to move your stop to track it if you'd like. So there's lots of different ways. This works on any market, any time frame, any direction. Works on tick charts, works on monthly currency pair charts, works on weekly stock charts, works on daily charts. So I like to use it trading intraday because trading the E-minis, you get these nice quick moves every once in a while, and you can take a quick 200 or 300% gain rather easily. Okay, so that's the rules in its most basic format. Let's show you some examples now so you really can get it under your belt. All right, so you can really fully understand this process, because up until now all we've just showed you is the basic format, but I want you to get familiarized and see how it works in any market in any time frame. So let's first start out with stocks. Okay, we're looking here at this chart in RAI. All right, now here's the 50-period moving average. Here's the Bollinger Band setup we have. Now initially price is below the 50. All right. But at this point, what do we have? We have 1, 2, 3, 4, 5 closes above the highest Bollinger Band. All right? Now, next thing we need to do is find a short-term top. Remember that little arrowhead right there, okay? So that's our proper setup. We have a proper setup now to go long, but we need to trade above that before we trade back down below the Bollinger Bands. So we need to trade up here in order to get long. And we did. We actually did the very next day. So we entered into the trade. We entered at 66.71, and we go backwards in time to find out where the last short-term low was, which is right here. So here's our stop. All right? All right, so we've entered here, we placed our stop here, and we measure the range. Remember, the range is from where the rally started, which started right here, to where the top of that short-term top was. All right? So this is 100%, however points this is. So we take that amount of points, and we simply, for wherever the top is, right here, we simply add that 100%. And that will give us 200%, which is 70.70. Now in the beginning, trading this, especially paper trading, I would like you to exit at the 200% range, just so you get a good feel for this, just so you understand how it works. I realize that some of you are saying like, well, you know, win-loss ratio is not very good, 1-to-1. Win-loss ratio is only applied when you have a strategy that doesn't do very well. This strategy is extremely consistent, and most of the times, I would say anywhere, in my mind, for the majority of the time, you're going to have some type of exit at the 200%. So we don't have to worry about win-loss ratio. If that does bother you, if that is something that you've been trained that you can't let go of, exit at 300. All right? So if you would have gone long RAI at the beginning of the year at 66.71, well, just in a couple of months, in the beginning of March, you could have exited for an 8-point gain at 74.70. Okay? How about going short? Oh, this is another thing I forgot to mention. This is why we like to exit at 300, because look what happened after that. The trend fell out of bed. So, you know, many times you'll see the trend end at 300 or 400%. So be very careful with trying to extend. I know a lot of students go, boy, this is amazing. If I made money at the 200%, I'll get out at 300. And then they say, boy, if I made money at 300, why don't I get out at 500? Well, sure, but oftentimes we've seen that at 300 or 400%, that's where the trend goes into some type of pullback or opposite trend. All right, let's look at UPS here. Okay, this was in March. This is just about a month or so ago. Now, we because of the way this is chart is formatted, we don't have the 50-period moving average, but we are below the 50-period moving average. Trust me when I tell you this. We're below the 50-period moving average. So what we want to do is count 5 bars below the lowest Bollinger Band, because we're going short now. We're just reversing the rules upside down. So we have 1, 2, 3, 4, 5 closes, consecutive closes below the lowest Bollinger Band. All right? See it right there? Now, next thing we need to do is look for a short-term low. That's a little V formation there, and it's right here. Okay? Now, we had the 5 closes, and the short-term low came after. So sometimes, even though you have 5 closes, the short-term low will not be formatted until after. So it's up to you whether you want to take that or not. All right, so we have the short-term low. It's a valid setup. This means we're going to be going short if we trade below this level before we go back up and close somewhere above here. So it's okay if we don't do it on the next bar. I don't want you to think that, well, do we have to go short on the next one? No, we can always, wait around 2 or 3 days, even a week, just as long as we don't close above this highest Bollinger Band. All right? Okay, so we were lucky because the very next day it did trade below there. So we got short. Remember, we do not care if it closes below there. All it needs to do is intrabar trade below there, which it did. So we're short at 98.69. We go back in time and we find the last short-term top, which was right here. So this is our stop placement. Okay? Now we just measure the range. Now we were kind of going lower here, but this is subjective. This is once again where these are not systems. Someone could go back and say, well, wait a minute, didn't the sell-off start way up here? This is completely going to be up to you. But most likely, you'll know where the sell-off occurred and where it started to. In our opinion, it started right here. We were kind of drifting lower to sideways, and then we started a nice sell-off. So here's the 100% range right here. Okay? Now, all we do is whatever amount of points that is, we simply subtract it now. Why do we subtract it? Because now we're going short. All right? So now we're going short, and that's where we would exit. And guess what? It's not a lot, only 2 3/4 points, but at the same, someone could say, well, boy, I had no idea UPS was going to be going lower. Now, one thing to remember is that the beauty of this is that you know in advance where your entry is going to be, you know in advance where your exit's going to be, you know in advance where your stop's going to be. If you don't feel comfortable, if you feel, well, boy, I don't want to be in the trade that long just to make 2 3/4 points, or if you're saying, that stop is too far away from me, well, then don't take the trade. See, that's the beauty of this. You don't have to. This is not a system where you have to take each and every trade. That's the only way this works, because over time, it's like a numbers machine. We don't believe in that. We want you to become a part of the process. Remember I said most people take their trading decisions from an outside source. That's why they fail. I want you to decide for yourself. I want you to say, you know what, this is a little bit too much for me. I'm going to pass on this one and look for another setup. Fine. There's setups all over the place. So if the stop is too small, or if the gain is not large enough, you do not have to take the trade. You are making the decisions. You're not relying on someone on TV telling you what to do. Okay, so now here's where we have a lot of students that trade options, and we realize that in this situation here in BIIB, this is an expensive $400 stock. We realize that not everyone's going to be able to trade a $400 stock on a daily basis. But what a lot of our students do is apply the same technique to options. In other words, once you get a buy setup and you go long, rather than purchasing the stock, you just buy an out-of-the-money call, because you're most likely going to have a nice run. You're going to have a nice trend, as you see here. So here's what a lot of our students would do. Even though we're not an option company, this is what they do. So, as I stated, there are 1,000,001 ways to trade this. We have roughly 5 closes here above the highest Bollinger Band, but see, we went back down below. So we negated that setup, and now we have 5 more closes. So this is a valid setup, and as you see, we created that little short-term top. So this is a valid setup to go long if we trade above, and as you can see, we did. Now, if you're purchasing the stock, you roughly would have bought it at 408. Place your stop here. Now, here's where a lot of people say, well, Steve, the stops are too much down here. Well, if you look, this was the last short-term low, so you don't have to place your stop down here all the time. That's just been coincidental that the stop has been at the very bottom of the range. But many times you'll see the stop a third of the way down, or maybe a half of the way down. So it's not going to be exactly 1-to-1 ratio. So your stop would be right here, because this was the last short-term low. So you entered here, but rather than just enter, okay, at that point, you would have entered on this day. Rather than just enter buying the stock, it's too expensive, all you have to do is buy calls. You could have bought the 500 calls, okay, out of the money. You could have bought the 480 calls, 470 calls. And in the next roughly month, you would have made nearly over 60 points, nearly 65 points, okay? We didn't take this because we knew that the stock was going higher by what someone was saying in some fundamental news, what earning report or something was going on economically. We didn't go long because someone in the chat room told us to buy this. We didn't go long because someone in the company said, tell your students, Steve, to go long. It's going to make 60 points in the next month. The only reason we went long is because we listened to the most important thing you should be listening to. That's the market itself. That's the chart in front of you. Don't concern yourself with outside sources. It's been my experience in my 38 years that these things only serve to really second-guess your trading. I say this from personal experience because that's the way I used to trade. I had maybe 20 indicators on my screen. I was waiting with bated breath for every news announcement, every earnings report, every economical indicator or report to come out. I was subscribing to every newsletter. We didn't have chat rooms back then, but we had newsletters. We didn't have trading rooms, but and I couldn't make a decision until all the things lined up. Once my mentors took me aside and said, Steve, let go of all those things. Simplify your trading and you'll get on that road to consistency. That's when I started to become consistent in my trading. So that's what we try to instill in all our students. Just look at the price here. If the market is telling you it wants to go up, that's our only job. It's just to jump on board. So all we do is teach you different techniques and structure on how to jump on board. It's not that complicated. There are only 2 jobs: to find out what the trend is, and then the second job is to jump on board. And that's really it. The reason why trading is complicated is because we make it that way. All right, so there was a nice 62-point gain. If we look at win here, this is going back once again this past month. And we originally were above the 50 period, or I should say the 50 period and the Bollinger Bands. We didn't have a setup in place. But guess what? Now we have 1, 2, 3, 4, 5 closes below, as you can see. And we created that short-term low. So all we have to do is enter once we traded below there. And once again, your stop does not have to be way up here. The last short-term high was right here. So you have a much smaller stop in this scenario. And you could have, once again, just gone short the stock if you were so inclined, but it still is a rather expensive $100 stock, so you could have just purchased the puts down about 20 points out of the money, and look where it stopped, right at the 200% range extension. But once again, for those of you people who are concerned about risk-reward ratio, well, your risk was right here, your reward was about 3 to 4 times more. So just look for those setups that have a smaller stop. Once again, we don't really concern ourselves with risk-reward ratio because we know of the consistency we have with our methods. But we're not going to dissuade you. If you really feel you must trade by those requirements, then fine. Look for those setups that have a smaller stop and a larger gains intact. Okay, now I'm going to show you an older chart of heating oil just to show you that this will work now on commodities. As we see here, coming into the beginning of the year, everyone knows heating oil was going lower, okay? We didn't care what the news was. We don't care what was going on economically or fundamentally with the world situation. All we know is that if price is below the 50-period moving average, you should only be looking to go short. That's our main rule at specialist trading. If price is above, well, then you look to go long. But since we're below, we're not going to try and pick a bottom in heating oil or crude oil. All we're going to try and do is sell it. So if you wanted to find a good technique to go short, well, here's a great technique, strategy 3A, which I've given you the rules to today. All right. So we have the closes below the lowest Bollinger Band, and this was, once again, this was back in November, or prior to the end of the year. We already knew we had a setup to go short. So there's our entry right here, and if you wanted to take full advantage, guess what? Here's 200%. 300% and 400%. Now remember, we said at 400% you should definitely be out of your position. We would suggest 200 and 300 in the beginning, but definitely if you have 400%, get out. Don't try to squeeze any more profit because most of the time the trend will change. And this is a perfect example. It did. Coming into February, all of a sudden we spiked up. And guess what? Now we have 1, 2, 3, 4, 5 closes above the highest Bollinger Band. And we have located a short-term top. Now, if our entry is in place, we will be entering above here, which happens to just be above the 50-period moving average. So this is a valid setup. Even though the majority of the bars are below the 50, our platform is above. I should say our entry is above. So all we have to do is just enter at 71.19. I believe our stop would be somewhere right here. And there's a quick 200 exit on the upside this time. So you see how you can ride this going down and going up. It does not matter. All we're doing is we've learned what the trend is by looking at these proprietary tools. And once we find the trend, we've just added a little structure on how to jump on board. Those are our only jobs as traders. We're not supposed to figure out what the fundamental news means. We're not supposed to figure out what's going on in the world. We're not supposed to have tons of indicators all lining up. We're just supposed to learn and listen to the market. All right, here's the QQQs to show you how this works on ETFs. This was in February. As you can see, we have 5 closes above the highest Bollinger Band, and we've created a short-term top right there. So our entry is a 104.18 in the first week of February, and our stop is just right here below this last low. And we measure the range. Here's where the rally started, straight up. Here's where that short-term high was. Here's 100%. And this was in the middle of February. All you have to do is add that to give you your first exit at 200%. And in just about a couple of weeks, you could have made a good 4.5 points, nearly 4.5 points. Okay, this is how simple it is. You could have used this as a market timing tool. You don't have to purchase the QQQs. You just could have said, well, if there's a rally in the QQQs, if we're going to have a nice 4 or 5 point gain here, well then that'll give me the confidence to be long maybe the other issues that I do trade, okay? All right, so we've shown you stocks, we've shown you commodities, we've shown you ETFs. Let's move on to the E-mini markets now for all you traders that like to trade the E-mini S&P. All right, here's a 30-minute chart of the E-mini going back just about a month or so ago. Where is price in relation to the 50-period moving average? Price is below. So this is telling us we're most likely just looking for a sell setup. We are in no way going to try and pick a bottom if price is below the 50-period moving average. All right? We see here that we have 5 consecutive closes below the lowest Bollinger Band. All right? And now we have to just find a short-term low, which is right here. That's our short-term low. So we have the option to go short if we trade below that based on where we would place our stop and where our exit would be. So let's say you wanted to take that. Well, your entry would have been at 20.65 1/4. Your stop would have been here above the last short. Here's where the sell-off started, right here at this top. So you measure the range, you subtract it, and roughly, and just this was a 30-minute time frame, so just in a couple of minutes, a couple of days, you made nearly 28 points. That's nearly $1,400 per contract, just trading this simple technique, okay? That was a 30-minute chart. Let's go down to a 5-minute chart, all right? This was on the, I believe it's the 14th. My eyes aren't that well, so I believe that's 4:15, maybe that's 4:16. Either way, this was just a week or so ago on a 5-minute time frame. Now, price is above the 50-period moving average, so it means we're going long, and we want to count 5 consecutive closes above, as we have 1, 2, 3, 4, 5. And within that, we have the short-term top right there. So you enter once we traded above that at 2100.75, and here's our stop just right here. Okay, so now we measure the range extension. That's 100%, and we just simply double that to give us 200%. So roughly in about 20 minutes, you made 3 points. That's $150 per contract. If you traded 10, that's $1,500. If you traded a couple, that's $300. And you could have ended the day there. This was roughly, I believe, in the day, the first half of the day. That's how simple this is. This is on a 5-minute time frame. Let's look at a 60-minute time frame. All right, now we're originally above the 50-period moving average, but then we cross below, and then we want to have a total of 5 closes below the lowest Bollinger Band. All right, so if we go forward, we see that we do have 5 closes, and we also created a short-term low right here. So this is our setup to go short. We can go short on this hourly time frame if we trade here below before trading back above, which we did. So you could have entered at 2082, placed your stop roughly right here, just about half the distance of the range, and then exited at 2064.5. 17.5 points in just about 4 or 5 hours. Okay, let's move on. I want to show you something that happened yesterday, because I know a lot of you say, well, Steve, yeah, this is great, but so far you're showing stuff that happened a month or so ago. Okay, let me show you something that happened yesterday. This is a 2,000 tick bar chart. This is before the rally. Actually, this is when the rally started yesterday and continued into today's action. But on a 2,000 tick bar chart, we see that we have 5 closes above the highest Bollinger Band. All right? Even though the majority of those prices are still below the 50-period moving average, we have 5 closes above, and we created a short-term top right here after we had 5 consecutive closes. And where would our entry be? Our entry would be above the 50. So this is a valid setup to go long. This was yesterday morning. So taking this trade, you would have entered at 20.90.75 and placed your stop just right here. Okay, not risking a lot. You measure the range where the rally first started. Remember, we started going up right here and then ended at that first short-term top. So that's 100%. And you simply double that, and 4.5 points in roughly about 10 minutes. Now that's if you wanted to take the 200% range extension. You maybe would have wanted to stay into the 300 and even 400. This was yesterday morning, actually. I think some of our students actually took this trade. So I've shown you E-mini tick charts. I've shown you E-mini hourly charts, 5-minute charts, daily charts. I've shown you daily stock, commodity. Now let's move on to the Forex markets for you Forex traders. Let's go to a different time frame. Let's go to a weekly time frame. Now, looking at this is the weekly chart of the euro-dollar going way, way back, about a year or so ago. Okay? Now, if you've been following the euro-dollar, if you're a currency pair trader, the euro-dollar has been getting killed. It's been going lower and lower. It's had some minor bounces, trying to bounce here and there, but most likely, if you look back at it, we've really been headed much, much lower. So what we want to do is apply this, but once again, if you rely on an outside source saying, well, I don't want to do anything in the euro until I find out what's going on economically or when I see what's going on in the world, you'll miss a lot of trades. It's much easier just to listen to the market you're trading. So all we have to do is see that we closed 5 times below the lowest Bollinger Band, and we created a short-term pivot low. Our entry would be below the 50, so here's our entry point to go short at 35.01. Now here's our stop, not all the way at the range, but just here. So all you have to do is simply measure the range, and if you really felt strongly that the euro dollar was going lower, look what you could have done here. 200, 300, and 400, and that's 471 pips per contract, nearly $15,000 just trading one last year on a weekly basis. Now that's a weekly time frame. Here's a 15-minute chart, and this was just a couple of days ago of the Australian dollar. Now we didn't have any setups here because they came back down below, but at this point we did have a setup. See how this setup right here, 5 closes above, and we created a short-term high. So we enter right there at 77.19 on this 15-minute time frame and exit just in about 10 or 15 minutes for a 46 pip gain. Now that's nearly $500 per contract if you're trading the large unit. And that's it. Do you see how simple this is? The trend was going up. We saw a little stall here. It met all of our rules, so we jumped on board and made a quick nearly $500. Now, let's recap before I go to any questions and answers we have for you. I know you must have a lot of questions, and thank you for holding off, but here are the highlights. Once again, this is a continuation strategy. If you've noticed, we've waited for trend to be established, then we waited for a little pause, we set up some type of structure, and then once trend goes back in that direction, we jump on board. Picture a train coming into a train station. You're waiting at the train station. Here you see a train coming down the tracks. It stops in front of you, you jump on board, and then it continues in the right direction. That's all we're doing. It uses the unique Bollinger Band setting. Remember, that setting is we're going to keep the default middle Bollinger Band at 20 period moving average. The top Bollinger Band is 0.382 deviation. The negative 0.382 is for the bottom Bollinger Band. Please remember, don't worry if you don't copy or get all this down. This is being recorded. You will see all of this in the presentation. Okay? This is designed to trade quick, powerful trends, as you just saw, in any market, any direction, and any time frame. If you want more signals, go down to tick charts, minute charts, tick charts, intraday, in any market. If you don't care, if you just want to get some nice big moves, and trade daily, weekly, or even monthly. But as I said earlier, okay, please paper trade this. I know I've shown you a lot of great examples. From time to time, sure, we will have some minor losses, but more important than that, I guarantee you will have losses no matter what if you don't fully understand how to implement this. You could have a winning trade, but if you don't implement it correctly, you'll most likely end up with a loss because you don't understand the rules. So please, paper trade this, study the video, the recording of this, paper trade it until you really fully understand it like the back of your hand. Our edge is consistency. We're not a systematic company. We don't teach or trade systems. I personally don't believe in them. What we do is teach and trade strategies. Those are 75% rule-based, but we allot 25% for discretion. And that discretion is your insight, where you may say, well, you know what? I don't feel comfortable with the risk-reward ratio. Okay, don't take it. Look for another setup where you do have a better risk-reward ratio. Or you say, you know what? I don't feel comfortable. There's just something about this. It doesn't feel good to me. That's fine. So we want you to, over time, get an insight into these strategies from paper trading them for a while. Now, in closing, I want you to ask yourself, before we go into question and answers, and here's the first question I want you to ask, and ask honestly, do you think any of these edges could have helped your trading this past year? Even if you say to yourself, well, Steve, that trading strategy really isn't for me. I don't like to trade that way. Okay, I understand that. But what if we had taught you the simple rule of only buying if you're above the 50-period moving average, or about only selling if you're below the 50-period moving average, okay? And what if I could give you 5, 6, 7 more type of edges that were just as powerful as what I shared with you today? I just want to take a few moments to tell you about the great package we have for all the Trading Pub attendees today. And this is my Secrets of a Stock Exchange Specialist training sessions. Now, a couple of years ago, I was asked to speak at a seminar in Denver, Colorado. I spoke in front of hundreds of people, and they were so gracious as to record the video for me of my 3 hours that I spoke. And what we've done is make this into a video training package where you get all the information that people came to see me speak in this 3-hour video course. I talk about many more trading edges, just as the one I shared with you today. I tell you which indicators to use and which ones not to use. I tell you what the difference is between a system versus a strategy. I go into detail about sharing with you what I feel is the #1 chart pattern you should be looking for in all trading techniques. And I think the most important thing I talk about is I give you the full rules to an entirely different strategy. This is so now you have strategy 3A. I give you all the rules in this 3-hour video course to strategy 1. In fact, here are some recent signals that our strategy #1 members took trading this technique. This is a pullback technique, so different from the one I share with you. We're actually looking to buy at lower prices as opposed to waiting to buy when you break out. So you see here how strategy #1 generated these buy signals in JEC just this past month, following the rules that I explain in the course. It also can give you set up rules to go short. As you see here, these were strategy #1 signals to go short in GPC, all profitable. You can apply this to ETFs, the IWMs, that's the ETF on the Russell 2000. These were buy setups using all the rules I share in this video to purchase. You could have applied this to trading the IWM, the Russell 2000 index. Here's a 60-minute chart of the E-mini, okay? These are all valid buy signals in every market, every time frame, and in every direction. As you see here, I believe this was on the 21st, so this was just a few days ago, 2 sell signals on a 10-minute time frame to go short the E-minis. And lastly, you can apply this to the Forex markets. These are all valid sell signals using strategy #1. Nothing is different, nothing changes for a market or time frame. The strategy stays the same if we're trading currency pairs on a weekly time frame or if we're trading E-minis on a tick chart. You get all the rules to this particular strategies plus many more edges, and in addition to this, you get access to my personal email address where you can contact me anytime you'd like. So if you're interested in getting this, now remember I said my sister site, which is Pro Trader Strategies, what they usually do is they will market this on their marketing page for close to $1,000 because it's 3 hours of just jam-packed information plus a full-fledged strategy. But because of our association with Trading Pub, we've dropped the price down to $37. So you can get all this information probably for less than the cost of going out for dinner. In fact, I'm almost sure that it's less than the cost for going out to dinner. Even if you went out to dinner by yourself, you probably would spend just that same amount of money. So I can't think of a better deal for only $37. Once again, plus you have access to emailing me with any questions that you may have on a daily basis, 24/7. So this is a 3-hour online course, once again, that people paid good money to see me speak in Denver. We're giving it to you for the low cost of $37. Here is how to access all that information. Remember, Pro Trader Strategies is my sister site. If you're interested, you can contact them at trading@protraderstrategies.com. Call them directly at area code 310-598-6677. Or you can use the link there you see at the very bottom. Now, the link I posted on this page is not live. You have to copy and paste that. But as you see there, I think Yana has so graciously posted that link there in front of you on your chat box. So you can just simply click that on, it's live, and it will take you directly there to get that $37 deal, okay? Now, once you click on that link, you'll see we have a lot more offers and different things for getting another strategy, probably some of our best strategies. But remember, you're not obligated for anything other than what you decide to choose. So just if you're only interested in the 37, that's fine. I want you to start out with that, and you're still a student of mine for only $37, okay? I want to thank you for holding off for any questions. I believe we still have about 5 or 10 minutes. So let me just open up this box here and just see. I'll leave this page up there. Let's see. Irma asks, how do you select the type of stock to trade with the Bollinger Band strategy? Well, this is pretty much a personal choice. Remember, first thing you have to decide is, what type of a trader are you? Do you like to intraday trade, or if you like to just look at daily stocks? If you like to just look at daily stocks, well, it's pretty simple. Most people have a select list of stocks they trade on a nightly basis. You can just have that setting with the Bollinger Band and the 50-period moving average and just go over them. It takes me maybe about 10 minutes to look at all the stocks because it's easy to spot. I've been spotting this for over 30 years, so it's fairly easy. Then again, if you're an intraday trader, well, most intraday traders only look at a few things, so I would always have those two indicators plotted on your screen. Once again, this is why we say to paper trade, because you'll be able to see all of these things unfold, but only through the practice of paper trading, okay? Someone said they missed the session. Is there another one scheduled? Actually, I believe they're recording this. Yes, Pooja, they're recording it, as you see there, so you don't have to worry about that. Melvin asks, what about day trading and a 1 minute chart? Well, Melvin, I just shared with you a 2,000 tick bar chart, which I think is actually a smaller time frame than a 1 minute chart. I also showed you some 5 minute charts, so obviously it works on any time frame, any direction. Okay. Juritus asks, on FX, how do we set up tick charts? Well, you know, that's probably something you should ask your tech support with that. I personally don't know what charting software you're using, and that's something you have to go back. That's a technical issue with your actual charting platform. Okay. Ed says, I assume this will work with Renko bars. You know, Ed, I actually don't use Renko bars. I know we have a lot of students that do, so therefore I would say yes, it probably does. But personally, you know, I can't tell you that because I don't use Renko. But we have a number of students who swear by Renko, so obviously I'm sure it does. Okay. On the Australian currency, it looked like it was above the Bollinger Bands and the 50 period well before your entry. Can you explain? You know, Vince, I don't want to backtrack because I don't know where that slide is. All I know is that it was on the Australian, I believe that was a 15-minute chart, okay? So it was above it, I believe, but remember, we stated that if price goes down below it before the setup, before you enter, then the trade is negated. That was one of the rules. So that's probably what you're talking about. Petra says, can we use the time-based chart, candle bar charts? Yes, it doesn't matter what chart you're using. Remember, the charts still will show you the top and the bottom of their ranges. Now, if you're looking at a candlestick, the top is called the top of the wick and the bottom of the wick. If you're looking at an open, high, low, close bar, it's the top of the range and the bottom. They're still the same price. And so all you're looking for is that short-term top or short-term low. Don't get hung up on what type of bar because you're still going to see the same prices, okay? Dave says, can you explain the stop and range points? Well, Dave, that's pretty detailed. I'll just say real quickly because I know we don't have a lot of time here. The stop is your stop. Once you've entered into the trade, let's say you're long, your stop is your last low, a short-term low, or the short-term low that was previous to entry. Okay. Once again, this is being recorded, so you can watch that recording, and then you just want to measure the range from where the rally started to where that first short-term high was, where you based your entry off of. That's your range. That's 100% from the bottom to the top, and you simply double that to get your exit points. Okay. Little says, when you did the reverse trade, you didn't wait for the 50-period simple moving average. Is it necessary to do that? Well, remember, our entry, if we're reversing, all that is in sync is that our entry is either above or below. I don't know which reverse you were talking about. All entries to go long must be above the 50. All entries to go short must be below the 50. So once again, that's a more advanced way of trading, but all you need is you know, an entry either above or below to be valid. Al asks, can we use the strategies in your special for forex trading? Yes, you can, Al. I showed the euro. I also showed Australian dollar. Sure. Do you recommend using the simple or exponential moving average? Good question. I recommend the simple because it's just very basic. Remember, we want to keep things as simple as possible, and we don't want to, you know, overcomplicate things by having a different moving average for each time frame for each market. So just keep it the same for each market, each time frame. Okay. Zeltko. Hello, Zeltko says, do 5 price bars must include the setup bar? That's a good question, Zeltko. No, it does not need to include the price bar. So in other words, you can have the first 5 closing above the Bollinger Band, and within those 5 have a setup bar where you have a short-term high. But it does not have to be there. It could be once you have 5 bars above, excuse me, then you have to wait maybe 2 or 3 bars for that short-term high to be created. Okay. JC, hello JC, says, I just saw that someone is using the PET-D as well. Is this an option? Yes, I don't want to really go into that because we're not talking about the PET-D, but the PET-D is a great trend identifying tool we have also at Specialist Trading, and you can use that as well, but it's a totally different package, so I don't want to really go into that, but there would be nothing wrong with using that if you do have the PET-D. Okay, just have time for a few more questions. Do you use any other indicators to establish momentum? Sometimes trade can be triggered and then reverse in the opposite direction. For this particular strategy, no. Now, for other strategies, yes, but most likely, you know, the markets are really simple. It's most likely when you get stopped out like that, you have a faulty type of strategy. But our strategies are very consistent. So even though we will get stopped out from time to time, we teach you different techniques and things to keep you out of those rangy markets, okay? Just time for a few more. I don't want to take any more time than Trading Pub is allowing me. Thank you all for the presentation. Thank you so much for attending. Can we look for this 5-bar pattern anywhere in the trend above the 50-period moving average, or only the first bar close above the Bollinger Band? Remember, you can look for this anywhere, just as long as your entry is above the 50-period moving average if you're going long, okay? I think that's about it. Everyone's saying they like the presentation. I appreciate it. And in closing, before we have to sign off here, I just want to say thank you so much for attending today, and I want to thank Trading Pub. I want to thank Raleigh and Yana so much for giving me the opportunity to speak. Because of our association with Trading Pub, we try to offer you all this information. So even if you don't want to become a part of our team and become a member, we still want to give you a strategy or something that you can apply in your trading on a daily basis without any cost, just education, because that's our goal. We want to educate traders so that rather than 80% of most traders losing, we want to change that number to read 80% of most traders being successful. So thank you so much. I hope you all become students and members of mine, and thank you so much to Trading Pub once again for giving me the opportunity to speak. I shall see you next time. Bye-bye.
Hey, well, thank you, Steve, for that great presentation on how you use Bollinger Bands and the 50-period moving average to trade these quick breakouts in the markets. I like how simple